My name is Brent Eckhart, and I'm a Senior Account Executive with CMG Mortgage, and I'm here to introduce you to CMG's Home Ownership Accelerator product. Now let's talk about what mortgages people are really looking for. When I ask a borrower what type of loan they want for their financing needs, they all say the same thing: a safe 30-year fixed-rate mortgage. They all tend to say the same thing about interest rates. They feel that they're all-time lows and they're going up. Well, do you know what I find funny about a 30-year fixed-rate mortgage? First, the 30-year fixed-rate mortgage was invented in the 1930s. In fact, in the last 80 years, the loan has not changed. Let me ask you a question. Do you know of anything in America that was invented in the 1930s that has not been improved upon in the last 80 years? Do you know the reason it's still used to this day? Profit. Profit for the banks. A 30-year fixed-rate loan is the longest term offered by most banks and therefore the highest interest charge. In other words, longest term equals most amount of interest paid to the banks. The average interest charge for a 30-year fixed-rate mortgage is 100% of the principal balance. Most people have no idea. In fact, if you get a really good rate on a 30-year fixed-rate conforming loan at 4.5%, your interest charge over 30 years is 82% of the original loan balance. That's crazy. But imagine if you got a really good jumbo rate at 5.375. In that case, your interest charge is 102% of the principal balance. Example, $1 million loan at 5.375 equals a payment of $55.9971 per month. Total payments of $55.9971 per month times 360 months equals $2,015,895.60. The original loan balance was only $1 million. That equals a net interest cost of $1,015,895.60. This is ludicrous. Over $1 million in interest. Does anyone really want to pay that much money in interest? Do you want to know what's even crazier than a total interest charge of a 30-year fixed-rate mortgage? First, let's be clear. Virtually everyone in a 30-year fixed-rate loan refinances well before the 30-year term. In fact, the average borrower refinances or sells their property within 3 to 5 years. The banks know this and even plan for it. During the first 5 years of a 30-year fixed-rate mortgage, the borrower will pay up to 25% of the interest charge. I repeat, in the first 5 years, the borrower pays on the amortization schedule 25% of the total interest charge. Example, if you have a home loan for $1 million at 5.375, your payment's $55.9971 per month. Total payments of $55.9971 per month times 60 months equals $335,982.60. Principal reduction over 5 years is only $76,937.40, but the interest charge is $259,042.20. In 5 years, the borrower has paid $77,000 in principal reduction and almost $260,000 in interest. Let's say someone stays in their 30-year fixed-rate loan. Do you know when the borrower's payments will equal 50% interest and 50% principal? Not until the 17.2-year mark. That's right. You would have to pay your monthly payment for over 17 years before your payment is going towards principal and interest equally. Every payment prior goes to pay more interest than principal. The bigger problem is that generally no one stays in a loan for 17 years. In fact, it is estimated that 80% of all Americans who can refinance have in the last 2 years. Do you know anyone who's been in a loan for 17 years? I don't. Now, let me ask you a question. How do other countries lend money for real estate financing? Further, what are other countries' banking models like compared to the U.S.? First, let's look at the U.S. banking model. Let's assume you have a mortgage with an interest rate between 4.5% and 5.5%. You also have a checking account with a bank and make less than 1%, and a savings and or CD account that pays you between 1% to 2%. Now let's look at a typical loan. If a borrower has a $500,000 mortgage with an interest rate of 4%, their monthly interest payment will be $1,667. Let's also assume the borrower has $100,000 in checking or savings accounts or CDs, paying around 1%. In other words, the bank will pay this customer $83 per month Therefore, if you take what the borrower makes, $83 per month from the bank, and subtract their monthly mortgage cost of $1,667, the borrower in effect is paying the bank a net interest cost of $1,583 per month. Now let's look at Great Britain's offset account. Assuming the borrower still has a mortgage debt of 4.5% to 5.5%, and the borrower has liquid assets with the bank in the form of CDs or savings account, in the offset model, the bank allows the dormant asset of the borrower to offset the principal balance of the mortgage, reducing the principal the borrower owes. So in this example, if the borrower has $100,000 in the bank, the net interest cost is based on $400,000 at 4%, or a monthly payment of $1,333 per month, rather than the $1,583 per month we are accustomed to in the U.S. This equates to a net savings of $250 per month. So which is better for you, the U.S. banking model with a net interest cost of $1,583 per month, or the British model of $1,333 per month? Is your money working for you or the bank? Let's look at my last loan. As I do with all borrowers, I asked him what type of loan he wanted. The borrower said, I want a 30-year fixed rate loan. I said, this will give you a payment of $2,838 per month. Do you like the payment? The borrower said no, but insisted on a 30-year fixed rate loan. I told him I wanted to present him with all of his options. For example, let's take a look at the Homeownership Accelerator. Granted, it's a 1-month ARM, but you could save a lot of money. The borrower said, Brent, I'm not interested in an ARM, but go ahead. First, I told him that the interest charge at 3.610 on $500,000 is only $1,504.17 per month. In fact, the HOA rate would need to almost double before he would be making a payment greater than his $2,838.95 payment he's prepared to make today. The borrower then said that interest rates could double tomorrow and continue to go up, and he would end up making a higher payment in no time. I told the borrower that I do not see that happening anytime soon, but fear is fear. So I asked him a question. How much money will you have in liquid reserves after closing? The borrower informed me that he would have $150,000 between checking, savings, and a few CDs. I asked the borrower, how much money do you make on those assets? He said around 1%. So if you're making 1% off your liquid assets of $150,000, you are making $125 per month. However, if you were able to float that $150,000 against your mortgage while maintaining 24/7 access to your funds, you would save an additional $451 per month in mortgage payments. I just lowered your minimum monthly payment down to $1,052, which is a savings of $1,786.03. The borrower replied, yes, but interest rates can still go up, and I wouldn't be able to sleep knowing I'm in an adjustable rate mortgage. To allay the borrower's fears further, I told the borrower that his rate would need to go up to 9.73 before he would be making a payment greater than his $2,838.95. More importantly, I told him that the life cap, the highest his interest rate can go during the lifetime of the loan, on this loan is only 9.5%. Therefore, he would never make a payment greater than $2,838 per month unless he didn't pay down the loan at all over the next 10 years. The line limit does reduce after 10 years, 1/240th per month, until the loan is paid off in 30 years. So then the borrower said, so there's no risk as long as I'm floating my assets against my mortgage? And I answered yes. The borrower said, what an amazing product. What an amazing loan. Where do I sign up? Do not let this opportunity pass you by. My name is Brent Eckhart, Senior Accounting Executive for CMG Mortgage. You can reach me at 831-566-0022, or you can call my inside sales associate, Kristen Shevlin, at 925-983-3051. Or you can always reach us by email at ask@cmgmortgage.com. Thank you for your time, and I look forward to working with you all.